welcome to this explainer. We are jumping right into the foundational mechanics of business finance today. And then we're going to pivot into a thrilling forensic investigation of corporate fraud. It's a really fascinating journey from the everyday balancing act of money coming in and money going out, straight into the hidden threats that are literally costing businesses hundreds of thousands of dollars. Let's get into it. Here is our roadmap for today. We'll start off with business yin and yang, then compare receivables versus payables, and explore the dark side of payables. From there, we are going to look at spotting fraudulent red flags, building anti-fraud controls, and finally, catching fraud with math. All right, Section 1, Business Yin and Yang. NetSuite hit the nail on the head with this one. Accounts receivable and accounts payable are the yin and yang of business. It perfectly captures the core dynamic here. When your revenues and expenditures stay in this healthy equilibrium, a company can seize growth opportunities, keep partners happy, and absolutely thrive. But, if you mismanage either side, that whole system can collapse like a house of cards. Moving on to Section 2, receivables versus payables. So here is the fundamental divide. Accounts payable, or AP, is your money out. On the balance sheet, it's recorded as a short-term liability. It's the money you owe to suppliers for stuff you've already purchased. On the flip side, accounts receivable, or AR, is your money in. This is a current asset representing funds you fully expect from customers for work you've already delivered. Basically, one is an obligation and the other is a promise. But to really wrap our heads around the cash flow dynamics, we need to reframe these kind of dry accounting terms into something highly relatable. So ask yourself this. Who is actually loaning who here? Think of accounts payable like this. It's essentially a free loan from your supplier. The goods are delivered, but hey, you haven't parted with your cash yet. From a cash flow standpoint, AP is actually a great thing. You get to hold onto your cash, keep the business super liquid, all while using the supplier's goods to generate value. In this scenario, you are the one receiving the loan. Conversely, accounts receivable is a free loan to your customer. You did the work, you delivered the goods, but you haven't been paid yet. AR can be a real cash flow nightmare because you're essentially loaning your own hard-earned resources to a client until they finally settle that invoice. And this is exactly why companies push so hard to collect receivables quickly, while strategically taking their sweet time to pay their payables. Which brings us to Section 3, the dark side of payables. $158,000. That staggering number is the median loss per business from just one single type of AP fraud, check tampering. We are not talking about pocket change here. These are massive losses that can completely cripple a growing organization. And the crazy part, it happens constantly. While check tampering is incredibly lucrative, it is just the tip of the iceberg. The most common AP fraud schemes also include billing schemes, ACH or automated clearinghouse fraud, fake expense reimbursements, and kickbacks. These are the hidden threats where fraudsters intentionally skirt controls. They might generate false invoices for products that never even existed, or quietly divert ACH funds straight into their personal bank accounts by tweaking payee details. It's honestly a sophisticated dark art. All right, Section 4, spotting fraudulent red flags. So we really have to ask ourselves, what does a fraudster actually look like? We always picture these shadowy hackers infiltrating mainframes from a basement somewhere, but the reality is way closer to home. Usually the culprit is an employee hiding right there in plain sight, sitting at a desk in the accounts payable department, using their insider knowledge to exploit system weaknesses. So the trick is knowing exactly what irregularities to look for during an audit. Are there unapproved vendors just hanging out in the system? Is a so-called vendor using a free Gmail address instead of a professional corporate domain? Are you seeing sequential invoice numbers or perfectly rounded dollar amounts? And here is a huge one. Do you have vendor addresses that miraculously match an employee's home address? Yeah, those red flags are the telltale signs of a scheme in progress. Moving to Section 5, building anti-fraud controls. Okay, so here's how you build a rock-solid defense. Step 1, verify all new vendors using a completely different person than the one who added them. Segregation of duties is key. Step 2, reconcile those accounts monthly. Step 3, conduct unscheduled, random audits to keep everyone on their toes. But Step 4 is absolutely brilliant. Mandatory vacations. Seriously, a mandatory vacation is an incredible control mechanism. It completely interrupts long-term schemes because the fraudster just can't maintain their cover-up while they're on a beach somewhere. While they are gone, a cross-trained employee takes over and boom, the ongoing fraud is suddenly and dramatically exposed. And finally, Section 6, Catching Fraud with Math. Enter Benford's Law. This was discovered by an astronomer named Frank Benford way back in 1881. It's a mathematical pattern that states the expected frequency of leading digits in naturally occurring numbers. Basically, this law outlines a natural, highly predictable curve for financial data. And the true beauty of it? Whenever there's manual human interference, like a fraudster making up fake invoice amounts out of thin air, it inevitably breaks this natural curve. Get this, in naturally occurring datasets, the number 1 is the leading digit roughly 30% of the time. From there, it just gracefully curves downward. The number 2 is the first digit about 17.6% of the time, all the way down to the number 9, which appears as the leading digit less than 5% of the time. The thing is, our human brains just don't intuitively grasp this. If we try to fake random numbers, we use the digits 1 through 9 way too evenly. Which perfectly illustrates how the bad guys ultimately get caught. Let's say your company requires 2 signatures for any check over $1,000. Well, smart fraudster knows this, so they write dozens of fake checks for $900 to slip under the radar. But suddenly, your accounts payable dataset has this massive spike in numbers starting with 9. Since 9 should naturally occur less than 5% of the time, this spike absolutely shatters Benford's Law. It acts as a blazing mathematical siren for auditors. The data literally points right at the thief. So I want to leave you with a provocative thought as we wrap up this explainer. If a fraudster tested your AP controls today, what numbers would they leave behind? Really think about your own organization's vulnerabilities for a second. Are your internal controls robust enough to catch the anomaly, or are you unwittingly handing out free loans to a thief hidden in plain sight? It is a critical question every business leader has to answer. Thank you so much for joining me, and definitely keep an eye on those numbers.